I want to talk a little bit about I think session two, you've already sort of, touched on them a little bit, but the development and project financing. And I want to talk specifically about, I always like when you can sort of put two things beside each other to sort of get perspective. And there's sort of the Aussie mentality and the North American mentality. And I want you to unpack again, I'm sure it'll be unpacked more at the symposium, but I'd like to touch on a little bit on the show, because I think it's an interesting perspective.
Sure. So look, there are a lot of small gold mines in the Western Australia gold fields that North American companies never would have built, just wouldn't have done it. And the Aussies did, and they were super successful, building a whole bunch of projects which are arguably should never have been built, but they were, and they were successful. So the question is how, and there's a real difference in how the capital markets treat projects in Australia compared to how they treat them in North America. In Australia, companies are broadly valued based on cash flow. North America, they're broadly valued based on net asset value or NPV. So North American companies are always talking about PNAV multiples, so price meaning market cap to the net asset value. Whereas in Australia, it really is about free cash flow, price to free cash flow, and that changes how you think about a project, because the Aussie mentality is basically what can I pay for? What can I spend? What can I do?
Mm.
And then turn that into some cash flow, and then reinvest that cash flow into a bigger thing, then reinvest that cash flow into a bigger thing. And eventually you get to the big project.
Right.
Whereas the North American developer approach is more, okay, this is what the project, this is the best value version of the project from an NPV
Oh.
standpoint, but then it takes a really big bite to get there. And I don't have any strong biases as to which model is the right one, because again, it's really project and context specific, but there are very different philosophies there. And again, it changes how you look at things. Um, you know, I think that manifests itself in development projects pretty significantly. Aussie companies have the larger Aussie delivery houses have been more comfortable taking project execution risk over the last sort of 20 years than North American companies have. So they'll
Yep.
do fixed price lump sum turnkey delivery of projects, whereas the North American houses have been a bit less game for that approach. And again, it has huge implications on the cost of a project for an owner. If just pick a hypothetical $100 million capital project, don't know what it is, it doesn't matter. But if you're going with an EPCM project execution model, your cost of capital, again, I'll just pick a nice easy number, is 10%. Whether it's actually that or not, it's not that important. But so $100 million project, your lender is going to insist that you have an overrun facility of probably 30%. So now you're at $130 million at a 10% cost of capital. Whereas for an EPC project, which is fixed price, where the delivery risk is transferred to the contractor, your execution contractor, their incentive is that if they find a way to do it cheaper, that's money in their pocket. You're paying the same value regardless of whether it's over or under. So they're incentivized to do it cheap. But then the lender looks at that and goes, right, that's 100 million and the number is 100 million. I don't need you to do the overrun facility. And because that risk is transferred, the cost of capital is half as much. So from an owner's perspective, $130 million at 10% versus $100 million at 5%, those are really different projects. And it all comes from the philosophy of how you're going to execute. Both of those things, if you're doing an EPC fixed price contract, if your contractor is incentivized to do things cheaply, then you have often an operability issue that comes with that. So you
Right.
have to find
Yeah.
a way to appropriately balance that. But these execution models, these aren't trivial things, and they span many different disciplines, and that's why we need to be talking about these things, because it really trickles down, and how you get the money, who you get the money from to execute your project. These are all really relevant topics.
Do you think it's going because of the increase in demand, though? Do you think some of that Australian approach is going to trickle over into the U.S. and into Canada and down into the Americas?
Yeah, and it's, in fairness, it's not just an Aussie approach. You've seen it with pretty successfully in companies in Africa, based out of South Africa as well. And some of those companies are traded on Canadian public markets. A really good example of this would be the Atlantic Gold Moose River Consolidated Project, which was eventually acquired by Santa Barbara. And look, that project was built on a shoestring, and it delivered its business model. And you look at it and you go, wow, that thing is lean, and that's fine. That's what it took to get that project built, and that is 100% the right model. So yeah, I think, look, the reality is, I don't think generalist money has yet understood the enormity of the challenge that it's going to take to electrify the world, and the enormity of the challenge in that material supply.
Yeah.
There was an interview with one of the founders of Tesla recently. He was talking about how the other auto manufacturers weren't really understanding the implications. They're saying, yeah, buy some nickel, make some batteries. And his question was, yeah, but they haven't thought through the supply chain yet. And so people are starting to have those conversations and think about the supply chain. Where are you going to get your nickel? It's a great question. Where are you going to get your copper? The copper demand over the next 10 years is going to be astronomical. And where it's going to come from when it takes 10 years to get a new mine into production, from 10 years from discovery to production is an efficient timeline. There are mines that happen faster than that, but most don't. So it's a pretty significant challenge, and I think you will see enough variation in the challenges of projects and the context of the individual companies executing those projects that you'll see a huge variety of delivery models. You'll see North American companies take Aussie delivery models. You'll see more collaboration, because the world, despite the pandemic sort of making the globe less accessible, it's also shrunk us in terms of how we have these conversations and how we share best practice, I suppose.
What was I going to ask? Do you think? Yeah. Oh, I was going to. I don't expect you to have this data just on hand, but these projects that are funded based on cash flow, do they have a history of being able to scale up later, though, to reach full potential? Or do you also, I would assume part of the reason that it doesn't get implemented in some places, because then there's that risk that it just ends up staying that size of project, and it really, you don't actually fully realize the asset potential.
Yeah, and that can be, usually once, the funny thing about capital projects is that the initial capital spend is usually the hugest hurdle to get over. If I look at our own portfolio, we have some brownfield assets that we've restarted, and if they were new mines being built, we probably wouldn't have done it. But because the site was captured, because there was a footprint there, the incremental capital was pretty reasonable.
The roads are built, and these
Exactly.
things. Yeah.
Yeah, all the facilities are there. It's got power, it's got water, all this kind of thing. And those are significant costs, especially if your mine is particularly remote. So once the capital to build your mine is sunk, the calculation is different, because then honestly, that money's behind you. You however you finance the mine to get it built, you have to make good on those commitments, obviously. But from there, the calculation, if you just do a forward-looking piece with debt service, or if you sold equity or a precious metal stream or what have you, those obligations carry. But then you're doing a forward-looking calculation, and the capital's behind you. And what that almost always says is do more.
Yeah.
If you can.
No, that's a really interesting point. Yeah. And I think of it, I mean, not even in the production world, you start off with a little camera and getting stuff out the door, get people moving, and then you can make much better cases for scaling up, because you have a little bit of data, you have something that actually exists. I guess that's why I've had people on the show, and I got to get some more on, actually, talking about these mobile plants that are being used. I mean, that they're a great opportunity to get a project underway, but then scale up at a later date. I'm sure in Australia, I think they're huge in Australia.
Yeah, so our projects are, I work on a lot of heap leach projects, and heap leach projects are really, from a processing standpoint, you're basically making a big pile of rocks and irrigating it with solution, and then you've got a really small processing plant to extract the pay metal from that solution. That they're not complex, but they're successful because they're cheap to build and they're cheap to operate. That's really, the story of heap leaching, particularly in the Southwest US, copper in Arizona and gold in Nevada. But those projects are successful because they are what they are, and the operators and the builders of them understand the risk profiles of those particular types of assets. And there's a huge difference between a 2 million ton a year small crushing heap leach project and 20-30 million ton a year copper concentrator.
Right.
People look at those and go, mining project. No, they're miles apart. And oftentimes people don't appreciate the challenges that come from those differences.
And I'm assuming that is actually that just right there. Is that something that's going to be covered at the symposium? Just understanding the distinction between these projects?
Yeah, definitely. A number of the speakers will be touching on that. That'll be a pervasive issue across all 4 sessions. If you're thinking about, you have to know the risk profile of your project from a design perspective. It trickles down into how you finance it. That'll be touched on for sure in the case studies. And then the other thing is the contract models, how you align interests and execute from there. It's a critical part of it.